Lesson 1, and we are going to start off with the top left hand corner of this wireframe. We're going to figure out the monetary environment. The macro top down part, this phase here is probably the most important. It sets the tone moving forward. Big picture, should we be net buyers or should we be net sellers or should we be out of the market entirely? Markets move based on liquidity, and what sets the direction of that liquidity is monetary policy. All assets rise in a rising liquidity environment irrespective of valuations or any other metric. Inflation and deflation set the environment for central bank policy. So if you can imagine central bank, they reduce the interest rates, it increases liquidity because we can borrow money cheaper, right? So the cost of money goes down and we're more incentivized to spending. Now there comes a point when interest rates are so low that it's not effective. Take Japan for instance. When interest rates hit rock bottom, corporations began paying down debt as opposed to investing in the economy. So there's a behavioral thing there. So where central bank policy is very effective is when you get that ramp up in interest rates right before a recession of sorts, and then when you get the pull back into the recession. Japan went a decade where the interest rates didn't move, and so it wasn't very effective. You need to have that fluctuation in interest rates in order to have a very liquid environment. So we'll move over to the spreadsheet and we'll start breaking everything down. So this is an introduction. I'm going to go through what all this means in today's video. On the download sheet, if you guys are unsure, you guys can read through here and you'll have all the information that you need based on the metrics that we're going to use in this today. The links to find that will be here, so you just got to search for them. And at the very end of the lesson, I'll show you exactly what to look for on those. So everything should be very simplified. We're going to start off here with the University of Michigan Consumer Sentiment Index versus real GDP. Why do we look at real GDP? Real GDP is adjusted for inflation. So you got GDP, which is a nominal number, and it includes inflation. Real GDP gives us a real indication of how the economy is performing. So for argument's sake, real GDP came in at 2.1%, while nominal GDP just came in at 4.1%. Now, when you adjust out the nominal number and you factor in the corporate tax rate, it comes in closer to 2%, right? So that was a very transitory number we just seen, and the real GDP number will be able to spot that. So this is typically what we look for. So what is the University of Michigan Consumer Sentiment Index? Essentially what the University of Michigan Consumer Sentiment Index is, it's a monthly survey of US consumer confidence levels conducted by the University of Michigan. It's based on a telephone survey that gather information on consumer expectations regarding the overall economy. When I tell certain investors that I look at soft data and survey-based data, they laugh. And what they don't realize is, as an investor, we need to figure out what happens tomorrow. We don't care about what happened yesterday or today. We need to figure out what happens tomorrow. And in that environment, we make the most amount of money. And when you look at hard data, which is production numbers tell us what happened yesterday, and markets already have a chance at discounting that. So it's possibly already in the price when you look at hard data. You would be very surprised at the correlations of some of these soft data points that give us leading indicators into the future and show us what's going to happen tomorrow. So this is a telephone call. There's 400 phone calls made every month. It's not a lot of phone calls considering the number of people in America, and it's got an 85% correlation to the GDP numbers. Investors obsess over GDP because 2 negative quarters of GDP is a recession, and it sets the tone for central bank policy. So if we can forecast where GDP is going before it happens, we can begin to prepare today for what happens tomorrow, and that's what sets the difference between a very successful trader long term and a very unsuccessful trader long term. It's about looking in the right area and simplifying the process, and this is as simple as it gets. So back to the chart. As you guys can see, very strong correlation between both real GDP and University of Michigan Consumer Sentiment Index. So recently, I've said that the GDP numbers should come in strong, which it did, 4.1%. I did believe it might come in a little bit stronger than that, the nominal number. However, 4.1% was expectation. We're starting to see it roll over, and if this continues to drop, so this tells us what's going to happen on the next print. If this continues to drop, well then we should expect that real GDP and nominal GDP should start to underperform moving forward. So this is a very, very, very strong indicator of what's going to happen with GDP tomorrow. So next we're going to move on from University of Michigan Consumer Sentiment Index. Now, because this is soft data, we would like as many different data points to confirm or deny what we already thought. So this is another survey based, which is the ISM PMIs, which is the Purchasing Managers Index. So what this is GDP versus the ISM PMIs. So real GDP, we mentioned a moment ago, inflation adjusted measure that reflects the value of all goods and services produced in any given year. The Institute of Supply Management, ISM, so this is the holy grail of the business cycle. This is going to be a whole lesson is going to be on this report itself. It's very in depth and there's a lot in it. For right now, we're just going to take the headline number and use it as a macro indicator to determine where GDP is going, big picture. So the ISM report on business is based on a national survey. Again, more soft data here. This is all survey based. And so it's based on a national survey of purchasing managers tracking changes in the manufacturing and non-manufacturing sectors. This is key, right? So manufacturing is the most important sector that we look at, even though it's a smaller portion of the economy. So services is about 70% of the economy, 65-70. Manufacturing is about 30 to 35%. The reason we focus on manufacturing is because it's real goods and services. If I go to a manufacturer and I sign a contract, it's going to take time for that contract to play out, right? So 6-9 months into the future, and we can forecast that going forward. If I was to go to an accountant or a lawyer and sign a contract, if I was to go to a service provider, the duration of that contract is not even close to the manufacturing contract. So if the economy starts to roll over and I go to a service provider and it takes a week to deliver the entire service, it's very hard to forecast what happens 6 months into the future based on that service duration. And so we focus more on manufacturing. And although it's a smaller portion of the economy, again, it's got the same 85% correlation to GDP. Very, very, very important. The ISM is considered to be one of the most reliable economic parameters of the US economy, and I wholeheartedly agree with that statement. Very in depth, and I've made an awful lot of money off this survey. It's very clear, concise. When you break it down, it's a very big report, but when you find what you need to look for and you present it in the right manner, it gives you fantastic opportunities. So it gives a very important early look at the health of the nation's economy. Very, very, very important. Essentially, the questions that are asked on the ISM are, for argument's sake, what kind of business do you expect to do 6 months from now? Do you expect to hire more people 6 months from now? It's all forward looking. It's asking purchasing managers of corporations what's going to happen in the future, or what their sentiments to happen in the future. And whether that's correct or not, the markets will discount it. The stock market, equity markets, and most markets in general, commodities, they're all discounting mechanisms. They discount today what's going to happen tomorrow. And that's why the efficient market hypothesis is total nonsense. Because if today the data is all very bullish, and we start buying today, and that bullish data that suggests in 6 months' time we're going to continue to be bullish does not materialize, the markets catch lower. It's not very efficient. However, because this is leading in nature, it also shows up the warning signs moving forward. So the chart itself, very simple. The ISM, once it's above 50, the growth level, so ISM is in blue and it's on the left axis here, and once it's above 50, its growth level, we tend not to have a recession. We can have weak periods, but we never have a recession below 50. So right now it's very strong on a nominal basis, and we'll show in a minute, because we're going to get into inflation and forward-looking inflation numbers, why that number is so strong. It's suggesting that GDP should continue stronger until this starts to roll over. This report is released on the first business day of the month, and it's extremely important to input this data as it comes out. So this tells us what's going to happen with GDP over the next quarter. So if we have negative GDP growth over 2 quarters, we're in a recession. So that is the ISM PMIs. Next, let's look at inflation. So inflation is extremely important. So essentially what sets monetary policy is the inflation rate. So core inflation is what we're going to focus on today. And essentially what inflation is, it's the change in price from what it is right now versus where it was last year. So rising inflation, if you can imagine, last year you buy a loaf of bread for $1, And this year it's now gone up to $1.20. The inflation rate is 20%, assuming that all that's in that basket is that loaf of bread. Now the basket has 100 different items, and it's not a perfect measure. They use hedonic pricing and a hedonic substitution to try and keep the inflation numbers lower. However, it's a measure of inflation, and we just want to know where the general direction of that inflation is. So core inflation is what we're going to focus on today, and core inflation excludes energy and food prices. And the reason it excludes both of those is because of the volatility in both their prices. Go and have a look at soft commodities and go and have a look at the crude oil price, and that'll give you a gauge of the volatility that's in both of those assets. So core inflation gives us a real beneath the surface look at the inflation for the consumer. So how does rising inflation affect monetary policy? When we get a period of rising inflation, the central bank's reaction is to raise interest rates. Now, we only had quantitative easing since 2009, and although Japan had it for the last 2 decades, in the United States they've only had it since 2009. So this idea of a taper is all rather new because we've had quantitative easing. All tapering means is the central bank will no longer buy bonds at the market, the quantitative easing. So there's a transition phase. The central bank are undertaking quantitative easing, which is buying bonds at the market. And then they move from there to a taper, which is when they stop buying those bonds at the market. And then finally they move to raising interest rates. So if you go back to 2013, in the United States, they started to talk about tapering. That was the first talk. 2014 they tapered, and then in 2015 they began to raise interest rates, and they've been rising interest rates since 2015 up until present day. And so the next thing we should be looking for is, when do we get the Federal Reserve put? And essentially what the Federal Reserve put is when the Federal Reserve stop increasing interest rates, and that'll tell us that we're going to get our last fumes of liquidity into the market. Now we'll go over the business cycle at the end of this presentation, and it'll tie all of this up together. So inflation, if inflation is rising, you should expect that the central bank should start to transition from a very easy policy to a very tight policy. And based on that transition, we should be focusing on specific assets in specific asset classes. So here we have the ISM manufacturing versus core CPI, and the ISM manufacturing has moved forward 10 months. So this is a very, very clear, concise gauge of what's going to happen tomorrow in terms of inflation, and we should continue to invest in inflation-sensitive assets. For argument's sake, inflation-sensitive assets would be commodities because they've got tangible value, and it's the expected inflation of these commodities that's causing core inflation to rise. If you can imagine, copper is not just used within the house. It's not just used within wiring, it's used within our cars, it's used within our mobile phones. It's very broad based. And when the price of copper rises, so does everything across the board. So if we're looking at core CPI, and core CPI is expected to continue rising above 3% over the next 10 months, we should expect that all those goods and services that consume copper, such as your iPhone, such as your cars, the wiring in your house, any conductive metal consumer product, should begin to rise over the next 10 months. And so we can begin to allocate capital just based on this chart alone. So this is 10 months into the future. It told us in late 2016 that you want to own copper. That was the absolute low. If you bought copper and you just held copper since 2016, you're doing very well. You haven't done anything since 2016. You've just held copper for 2 years. Very easy. Come up with the strategy, buy the asset, do nothing. Good investing is boring, right? Just put the trade on in 2016. You follow your leading indicators. It says we should continue to own copper even to this day. And that's what we should do. Follow the leading indicators. You can take a deeper look at production, but that's essentially how powerful these charts can be. So that's ISM manufacturing versus core CPI. All you have to do is input the data and make sure the chart updates, and it spits out trading ideas for you. So moving on to our next inflation indicators, we're going to look at the velocity of M2 money stock. So what is M2 money stock? M2 is a calculation of the money supply that includes M1. So M1 is cash and checking deposits, very liquid money. M2 includes what's called near money, and near money is a little bit illiquid. So you got saving deposits, you've got money market securities, mutual funds, and other time deposits. So you're going to hold them for a period of time. Near money is illiquid, but it can be converted to cash rather easily. So we measure M2 as a gauge to get all easily convertible cash within the economy. So we're looking at the velocity of that M2. So we're looking at the velocity of easy cash within the economy. So the velocity is the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given time. If you can imagine, the velocity of M2 starts to rise. What does that tell you? It tells you that there's more transactions in an economy to buy domestically produced goods and services. And if that's the case, it would drive inflation higher. Because if there's more transactions for goods and services, demand for those goods and services increase. And as demand increases, supply reduces. And then eventually you start to see price hikes, inflation, due to strong demand. And so the velocity of M2 is a very strong indicator of what happens to inflation moving forward. When you're building out your process, you have to think in very simple terms. You have to think very different to everybody on the street. And I don't hear anybody talking about velocity of money. And quite frankly, this is something that I keep under wraps for myself because it's such a fantastic gauge moving forward. It's very consistent. Transactions increase, demand increases, inflation increases. And if the inflation is increasing, then we expect that the central bank will have to react at some point in the future. So moving over to the chart, the data for the velocity of M2 is released on a quarterly basis, right? So it's not out on a monthly basis. However, it's leading in nature 18 months into the future. So just like the ISM, this is telling us that core inflation should continue to rise over the next 18 months. Now, whether it rises over the next 18 months or not, we don't really mind. We just want to know where it's going over the next 6 months, and then we'll revise our whole process in 6 months' time. So for right now, it's very, very, very clear that inflation is continuing to rise. We have rising interest rates since 2015, and now that's beginning to affect GDP numbers, right? So what is stagflation? Stagflation is when growth slows down, but inflation doesn't. And that's an environment that I've been talking about recently that we may be entering. One reason why I like the Australian dollar, stagflation. So again, all you got to do is input the data, update the chart, and immediately you should already have a perception on this. Move on to the next chart. Very simple to build out a process when all you have to do is input the data, update the chart, and then see visually where we're at. Move on to the next one. Write it down on a piece of paper. VOM2 is suggesting higher inflation. ISM suggesting higher inflation. UMSCI is suggesting that GDP may have peaked. And then you come to the conclusion at the very end that we're in a stagflationary environment. Where do we go in a stagflationary environment? Then you start allocating assets to that. What asset classes do I want to be in? What is the reaction to a stagflationary environment? This all takes about 1 hour, no more. So next we're going to look at ISM manufacturing prices. So what is ISM manufacturing prices? It reflects a change in price paid by industry representatives for the products or services they receive. So it's input prices rising. So if you can imagine, I'm producing a good or a service, and in order to produce that good or service, say it's build a home, I need lumber. So I go to the market and buy lumber. But every time I go to the market to buy lumber, that cost of lumber keeps rising. So if you go and look at the lumber price right now, it's just continuing to rise month over month over month. That cost is going to rise so much that it's going to start eating into my margins. So what do I have to do to maintain my margins? I have to increase the price of a home, a newly built home. So I go and build a home and I increase the prices. That causes inflation. That continues to cause inflation passed on to the consumer. All of this is cyclical. Eventually, you're going to see that inflation feed into monetary policy. Interest rates will rise, and then the demand for housing will fall. And so if you go back and look at this year alone, and this is a very relevant topic, if you go and look at the prices paid for a home and the nominal value of a sales price of a home, it's collapsing right now, right? So input prices have been rising rather aggressively. For argument's sake, in the housing industry, we look at lumber, and that's being passed on to the consumer. Factor in the higher interest rate, which we know because we just looked at the inflation numbers, and then we do not want to be in real estate, certainly not in the United States. right? So right now we've already come into 5 different charts. This will only take you 5 minutes, and we already have an investment team that we would have spotted a long time ago. So back over to the chart. Above 50, input prices are rising, and we're well above 50. So this is very late cycle. So as you guys can see here, in the 2008-2009 lows, we have what's called mean reversion in a lot of asset prices. Now that's just because they've been so oversold, but that causes inflation, and that's the start of the cycle. Midway through the cycle, you see demand come to the forefront, but you see those asset prices cool off. And then at the very end of the cycle, you start to see aggressive inflation return to the market. And so that's pretty much, if you were to look at Elliott wave and 5 waves up, you've got your impulsive first wave, your wave 2 pullback, and then your very strong wave 3, and then you have your wave 4, and the final 5th wave is so hard to catch because you have the Federal Reserve put, and it's all speculation. Right, so if you're to look at the market, that final 5th wave makes no sense to a lot of people because we're running on the fumes of liquidity and everything else is rolling over. So when you understand the behavior of the cycle, which we'll talk about at the end of this lesson, you'll start to see exactly how different asset classes behave based on all this data in front of us. So why is the ISM so important? The rate of change of both the ISM and the S&P 500 are the exact same chart. Right, so if we're expecting weakness in the ISM based on our inflation and our monetary data, we should forecast that the S&P 500 should have weakening returns. So it's very important to follow this process in order to forecast where equities are going. But as well as that, we also know where monetary policy is going. And if we are perceiving interest rates to rise, we want to own the dollar. And if we're perceiving interest rates to fall, we don't want to own the dollar. If we're perceiving inflation to rise, we want to own copper, maybe crude oil, right? So this here is macro based across the board. We can literally invest in any asset class based on these couple of charts alone. Now we're going to go into a lot more detail over this whole course, and it's going to break down right to the bottom, and it's going to pinpoint exactly where you want to be for the best returns moving forward. This is just rough drafts of where we should be investing at some point in the future based on the larger macro picture. And so if we're expecting the S&P 500 to roll over, what happens to federal tax receipts? They start to roll over as well. The reason this happens is because the top 1% pay 30% of total taxes. And the top 1% have the majority of their money in the equity market. And so if the equity market rolls over, so do federal tax receipts. And what does the government have to do? Widen the deficit. Here's another investment opportunity. Widening deficits correlates very strongly with rising gold prices. So across the board here, we've gone from GDP to inflation to input prices, and we figured out that we could be long or short currencies, commodities, or equities, all based on the same fact. Even fixed income, right? Because it's playing with monetary policy. So all 4 asset classes, we've got a good representation of where our biases should be. Should we be long or short equities, bonds, commodities, or currencies in the current environment? So just to recap and give you some practical guidance on what I'm seeing that federal tax receipts are rolling over. I'm seeing that interest rates are a big issue. And I'm seeing that the Federal Reserve may have to change policy irrespective of the inflation data because of what's happening to federal tax receipts. If you look at the government debt is 20 trillion. If the interest rate goes from 1% to 2%, the cost of that 20 trillion increases. And at the same time as that increasing, the majority of the revenue that the government receive in terms of the top 1% and the S&P 500 is starting to decline. So the only way the federal government can continue to service that debt is at a lower interest rate. So we should be expecting a federal put soon. We should continue to see commodities rise because of the inflation. Copper is certainly one that I would expect continues to rise. And I don't think you want to be long the dollar because we're expecting that transition in monetary policy. So it should be very easy to digest everything that we've gone through here. It's very important to understand the characteristics of each cycle, which we'll get into right now. So let's take the inflationary lesson that we just learned and the effects it have on monetary policy, and let's figure out how we can use that in the cycle. because cycles repeat themselves exactly the same from a behavioral standpoint, year after year, decade after decade, century after century. The characteristics of a cycle are always the same. So using Elliott wave, because Elliott wave is all about emotions in the market, I've marked off what the typical wave one would be, the characteristics of a wave one. It's actually the late part of a recession, this part here, where prices start to rally. This is when central banks become more accommodative, they reduce interest rates, maybe even they ease, and inflation concerns start to subside. So when the interest rate declines, the lower interest rate causes stock prices to rise. And this is almost like a stealth phase of the new bull market, because economic conditions are so dire, yet equity prices continue to rise. Markets do not move on valuations, they move on liquidity. The whole world is priced off the US 10-year yield, which is in less than 2. We'll go into that in more detail. So liquidity is extremely important. And in order to gauge liquidity, we have to look at inflation. So inflation tells us where we're going to be at some point in the future. So for a wave one, of a big degree, so this is a weekly chart of the S&P 500, we should be looking for recessionary concerns to intensify. So if you go back to 2009, 2010, 2012, if you guys were trading through that period, you'll remember in the news day in, day out about this double dip recession that supposedly was happening. And in fact, it was the increased liquidity that drove equity markets higher. And an awful lot of people miss the early stages of the bull market because they're focusing on the wrong things. We need to focus on our macro top down. That's why this phase is so important. We need to figure out where the liquidity is in the market, and we need to move forward based on that. So that's the characteristics of a wave one. Commodity prices and inflation hedge assets continue to be weak in this phase because it's when asset prices roll over and you've got disinflation. So if you can imagine, commodity prices have tangible value, and in a disinflationary world, the price continues to fall. So you don't want to own commodities. The best asset you want to own in wave one is equities. Moving on to wave three. So this is the strongest phase of the bull market. Demand for interest rates, sensitive items, housing, cars. When interest rates are on their lows, more people want to buy interest rate sensitive assets. So it starts to pick up. Retail sales pick up because credit cards are used more often, and it's the low interest rate that provides this liquidity into the market. There's an ample amount of credit in the market that causes this massive burst higher in equities. This phase is also supported by inventory rebuilding. So after your recession, you start to see companies and retailers start to liquidate their stock, offering sales 50% off, 70% off, just dumping all their inventory right into the depths of the recession. And as growth starts to pick up, they have to rebuild that inventory. And by rebuilding that inventory, they have to increase capital expenditure. And by increasing capital expenditure, they're adding to the growth rate. So we should see in excess of 4%. Inflation continues to be low in this phase. So if you remember, bond yields continue to drop throughout this wave 3 right into 2016. It wasn't until 2016 that we seen inflation rise. And that was when commodities really started to pick up, and that was the wave 5. So during this wave 3 of the business cycle, if you will, I'm calling it almost like a chart, like this equity market is the business cycle, but it's the clearest pictorial reference I can give you to the business cycle. So during this wave 3, this is where everybody wants to be long the equity markets because they outperform. I'm calling this the early stages of the business cycle because the economy is actually lagging the actual equity markets. This is what we call late cycle, and this is the tightening phase. And we're in the tightening phase right now. We started the tightening phase back in 2015, December 2015. And this, we know when the tightening phase starts that it's the beginning of the end, because the next phase we move to is early recession, and then we go into late recession and we start the whole cycle over. So tightening phase is reduced liquidity. So the Fed turned restrictive, which shows up in reduced liquidity. And the money supply gets cut off, credit growth gets cut off, and spending gets reduced, and equities start to roll over in a big way. And as I said, this is the beginning of the end. So what we should be looking for right now is preparing for ourselves, based on the current cycle, of course, for the recession to come at some point in the future. We need to be very nimble and very careful about what we do. So guys, this is a very brief view of the business cycle and why we use the business cycle in conjunction with inflation to measure monetary policy, because monetary policy is the driver of liquidity, and liquidity is the driver of all asset classes globally. Extremely important to make sure that we follow inflation numbers, growth levels, GDP numbers in order to figure out where we are in the cycle. So with that said, this is the end of the very first lesson. The next lesson we're going to move into is actual liquidity. Inflation data tells us where we should be going, and the liquidity numbers tell us where we are and what we should be doing. So for the next tutorial video, we'll be focusing on liquidity itself and how that affects our investment process from there. So before I leave, the first thing I want to do is show you guys how to find these links. So ISM report on business, we need to find two different numbers from this report on business. We need to find the ISM number itself, the headline number, which we use over here for versus real GDP. And we also need to find prices, which is on the same report. So ISM prices is input inflation for goods and services that are being manufactured. So that's all on the same report. So I've just put ISM report on business. So both of them have the exact same link. Paste it into your browser and it'll bring you to this page here, which is the ISM report on business menu. And so what we're looking for is latest manufacturing report on business. This one right here, the very top one. Now, as I said in the tutorial, this is a very in-depth report. So all we need to do is just, for right now, just take what we need. So scroll down until you see this here, which is a big index tab. And we're looking for PMI headline number. Make sure that you're getting the latest one, which is June. So this is released today. So today is the 1st of August, the first business day of the month. The manufacturing is released. The third business day of the month, the services, the non-manufacturing is released. So this will be updated today. So you come here on the 1st of every month and you take the PMI number and you take the prices number. Both of those and input it into your data. Very simple. Come copy, paste it in, update your chart. So back over to our Excel spreadsheet. Next we need to find real GDP. Now, I always like to make sure that the data that I'm receiving comes from an official web page from the government. So this website is the Bureau of Economic Analysis, so bea.gov. Back over to the web page, input it into the browser. What we're looking for is current dollar and real GDP. Click on that. Excel spreadsheet pops up down here. Click on that. And the spreadsheet will open like this. And so we're looking for real GDP, and it's this number right here. We want seasonally adjusted GDP in billions of change 2012 dollars, and you'll find inflation adjusted, it's below the $20 trillion that the nominal number's at. So if we go down to the bottom here, you'll find it's 18.5 trillion. So it should be a little bit less than the number everyone talks about because it's inflation adjusted. So this is the column that we take it from. We input it into our charts, just the number, and then to the right hand side of it there's a code. Just drag that code down and it'll update the year over year rate of change, and we use that number. So all you got to do is take the nominal number here, which is 8.5 trillion. So this is in billions. So this is 18,507.2 billion. So it's 18.5 trillion. Just copy and paste that in and drag the formula down and you'll have the year over year rate of change. Back over to the spreadsheet, University of Michigan Consumer Sentiment Indicators. So this one here, Control C, copy that. And very simple here. The index number is the one we're looking for. We're going to go through this report again in more detail in a video, and it'll bring you to the University of Michigan website. And so all we're looking for here is the index of consumer sentiment. We'll go through this report again in more detail once we're starting to look at the US economy in a little bit more depth. So don't worry about the report itself. You just come, take this number here, and then we'll come back and we'll analyze this at some point in the future. So that's the number there you're looking for. July 2018, headline number 97.9. Copy that into your chart and update the chart. All you got to do. And finally, the velocity of M2 money is on the St. Louis Fed page. So copy the link into the browser and it'll bring you to the St. Louis Fed page. This is a quarterly number. So it's typically at the end of each quarterly report. So end of July, next one will be October, then January. So it's something that doesn't need to be updated too often. The next time we're going to be updating this won't be till October. So do remember to come back to this every once in a while and make sure that you're updating your chart so you can stay up to date with your inflation analysis. So you can either take this number, or if you've missed a couple of quarters, download it into an Excel spreadsheet, and it'll give you the dates and the numbers that you need to copy them over, put them into your chart, and again update the chart so as we can gauge where inflation's going in the future. Very, very, very important. So that is it for the analysis and the input numbers that we need. They are all the links that you need. As well as that, I've got a page here of types of inflation and what Elliott wave cycle you typically see it in. So this is big picture. At the very end of the lesson, we looked at a chart and we discussed the characteristics of each period within the cycle. So when we look at inflation, and inflation is so important to gauge where the central bank are going to move next, the type of inflation we can determine based on the environment we're in. So if we're in demand pull inflation, for argument's sake, when demand is exceeding supply, we're typically in a wave 3, meaning we should expect a little bit of weakness in the future, but we won't see a recession. We should see that final fifth wave. And that final fifth wave is cost push inflation, where the price of goods and services are rising because of the cost of commodities rising and not necessarily because of demand. Inflation's almost like a silly dog. It rises until it doesn't know why it's rising, if that makes sense. So cost push inflation is when demand slows down but the price of goods and services continue to rise. And that's the end of the cycle. That's when you see interest rates rise, that's when you see inflation, and that's when you see demand start to roll over. That's when you run the risk of stagflation. So what I've done here is I've put out the different scenarios of inflation, a little bit of a recap of what they are and what Elliott wave we should expect to see them in. So the first wave, the third wave, end of the third wave, early fifth wave, and then fifth wave. So have a quick read over those, and I've also put that chart in here for you guys to read so that you guys can revisit this at any point to try and figure out the characteristics of each part of the cycle. So with that said, this will be the end of the tutorial.